Hello everyone and welcome to my YouTube channel. This video continues with the 8th part of the series, How Does Money and Our Global Economic Cycle Work? It starts right after the intro. Stay tuned.
Insights for the informed investor.
P2P loans or peer-to-peer loans. Have you heard of P2P loans? If no, then you should definitely find out more about them. They are becoming increasingly popular as they offer an easy way to find and use capital. Basically, P2P loans are personal loans that you lend to another person. The advantages are many, but you should also protect yourself against possible risks. One decisive advantage is that you will quickly find a buyer for the loan amount you offer. Nowadays, there are numerous platforms that make it easy to process loans. You should take advantage of these benefits and maximize your capital. Another advantage is that the loans are transparently innovative. On first reading, you may think that the complexity of these loans is too heavy. On closer inspection, however, you will notice that these loans are not as complex as you might have thought at first. You can imagine the whole principle roughly as with a normal personal loan. For example, you lend money to your friends. As a rule, you do not charge an interest rate for these loans. However, you now have a P2P loan. With this one, you have an interest rate that helps you maximize your capital. The platforms check the borrower's creditworthiness so that you are on the safe side. Which actually brings us to the next point. P2P loans are a simple way to achieve high returns. The almost double-digit annual return in some cases ensures that many people take out P2P loans. Another crucial point is that this form of loan is not subject to fees. Both lenders and borrowers do not have to pay any fees, which is a huge advantage. Furthermore, the platforms always provide you with loss protection. The modern platforms for P2P loans offer a buyback guarantee if you fall into the loss zone. But let's also look at the disadvantages of this form of credit, because everything has its pros and cons. As P2P loans are an innovative form of lending, this form has not yet experienced a currency crisis. As a result, the future of this form of lending is still uncertain. Furthermore, there are still no major legal requirements, which means that you always have a small residual risk. However, this residual risk is very low, as the platforms check many things before granting a loan. Another disadvantage is that there are no statistics yet. This is also due to the fact that these loans are still very new on the market. What actually happens if the lender becomes insolvent? Yes, that can happen too. If the lender is no longer solvent for reasons other than a financial crisis, you have to think about something quickly. The buyback guarantee won't really help. As an investor, you should therefore ensure in advance that you have appropriate security. This gives you the great advantage of benefiting from the return and not suffering any major losses. Finally, however, one particular advantage should be mentioned: automation. With P2P loans, as you gain experience, you can ensure that you completely automate this type of lending. You can grant loans on a daily or even weekly basis. Numerous people are looking for ways to get a loan quickly. You should take advantage of this gap in the market. At the end of the day, there is a decisive advantage for both you and the borrower. In the future, you may even be able to work together on a long-term basis. One or two new ideas may arise if you give a startup a P2P loan. This can quickly lead to new business relationships that pay off in the long term. CFD, or contact for difference. You've already learned about ETFs, but CFDs, what are they? What distinguishes them and what advantages can CFDs offer you? A CFD is a highly speculative derivative. You should therefore only use this investment option once you have gained sufficient experience in various markets. You should be aware from the outset that you can achieve a high return. However, this is always associated with a high level of risk. The more experience you have, the better, because even experienced investors fail from time to time when investing in CFDs. But that is also quite normal. This is the only way to gain the experience you will need in the long term. The advantages of CFDs make them so attractive for investors. You can trade with just a small amount of capital and also have a wide range of underlying assets. Another crucial point is that you have low transaction costs and flexible trading times. You should also make sure that you have a high level of transparency in pricing. If these advantages do not yet make the appeal of CFDs clear to you, you should take a close look at the following advantages. You can not only bet that a certain share price will rise, but also that it will fall. In addition, CFDs give you leverage effects, with which you can generally realize high profits. However, it should be noted that these leverage effects should be chosen with caution. With leverage, you ensure that your invested capital multiplies. However, leverage also ensures that your risk multiplies at the same time. In the beginning, it is definitely better if you distance yourself from leverage. Over time and after a certain number of investments, you can then use leverage to multiply your capital even faster. The disadvantages naturally follow from the advantages. One major disadvantage is the risk you take when trading CFDs. You should really consider your own risk management here. This will ultimately ensure that you can also achieve good returns with CFDs. Crowd investing. Now we come to another type of investment, crowd investing. This type of investment is becoming increasingly popular. But what is it anyway? Crowd investing is a form of crowdfunding in which you participate financially in the success of a project. The return aspect plays a major role here. You minimize your risk by investing with many other people so that you can start with small amounts. You also have the same return as the other people who invest in the same project. This is usually very high, as crowd investing often involves high-risk projects. Crowd investing allows you to invest in different types of projects. These include startups, real estate projects, sustainable energy projects, and many other innovative business ideas. Startups particularly benefit from crowd investing, as they often have difficulty obtaining traditional financing. Investors therefore have the opportunity to be part of innovative companies right from the start and benefit from their growth. A key advantage of crowd investing is the democratization of investment opportunities. Traditionally, only wealthy private individuals or institutional investors have been able to invest in promising projects. Crowd investing breaks down this barrier and allows anyone to participate in lucrative projects, regardless of the amount of their capital. However, you should be aware that crowd investing is associated with high risks. The projects in which investments are made are often at an early stage of development and can fail. It is therefore important to obtain comprehensive information about the projects and only invest money that you can afford to lose. Crowd investing platforms usually provide detailed information about the projects, including business plans, market analysis, and financial projections, to help investors make an informed decision. Another aspect of crowd investing is the social component. Investors can support projects that they personally find interesting or worthy of support. This can be, for example, the promotion of sustainable projects that promote environmental and climate protection, or the support of social enterprises that address social challenges. The legal framework for crowd investing varies from country to country. In many countries, specific laws and regulations have been introduced to ensure the protection of investors. These regulations may include minimum standards for transparency and information requirements for promoters, as well as caps on investment amounts. In summary, crowd investing is an exciting and innovative way to invest in promising projects while spreading the risk. It opens up new avenues for investors and project promoters alike, but also harbors risks that should not be underestimated. It is therefore advisable to keep a close eye on the development of this market and weigh up the risks carefully before investing. Cryptocurrencies. Cryptocurrencies have been on everyone's lips for some time now. We keep hearing that Bitcoin is rising or falling. Many people point out that you can't trade on this market at all. However, this is not entirely true. It is perfectly possible to make profits on this market. To do so, you need a basic knowledge of current technical developments. Bitcoin itself is already interesting, but the technology behind cryptocurrencies is even more interesting. Almost all coins are based on blockchain technology. This technology allows you to send data anonymously. It also saves on data storage, and future developments in this area remain to be seen. The potential applications of blockchain are huge. For example, it could be used in a doctor's surgery. If patient data is to be sent anonymously to another doctor, the technology can be used immediately. This allows you to take advantage of many benefits and also ensures that you no longer have to worry about the data falling into the wrong hands. As you can see, the technology offers many opportunities in many areas of business. But how can you trade cryptocurrencies? To start trading cryptocurrencies, you first need to create a digital wallet. You can do this with numerous providers online. With some providers, you can create a simple wallet within 2 minutes. Make sure that you never give out your private key. This is the same as your PIN code for your debit card. You can receive money via the public key and then manage it in your digital wallet. If you want to receive digital currencies, you can pass on your public key. This corresponds roughly to your IBAN. To start trading, you need to buy Bitcoins in exchange for money. These coins are used on all platforms to buy other currencies. Once you have bought Bitcoins for your amount of money, you go to a crypto exchange with them. A well-known exchange is Binance.com. Now load your Bitcoins from your digital wallet to your wallet on the respective exchange. You will now see various crypto pairs. You can exchange your Bitcoins for Ethereum, another coin. This is how crypto trading works. One thing is certain, the developments on the current market are similar to those in the dot-com era. Accordingly, you should trade with caution. There will still be numerous coins that will disappear from the market, and that is a good thing. For you, this means that you should really focus on innovative projects. You should also gain an insight into the team behind a coin. Once you have an overview of the technology, the market, and the respective members behind a coin, you can make your investment decision. A list of currently over 2 million crypto coins and tokens can be found at coinmarketcap.com. Now we come to the really important point in this chapter. Let yourself be unsettled. The media are largely unfamiliar with the new crypto market. Accordingly, you should not rely on the media. Do not believe any experts. Make sure that you get your own picture of the situation. The crypto market is not even close to being worth as much as Apple, for example. Accordingly, it is also normal for the market to be subject to high price fluctuations. Your price may fall by 10% in one day. On the other hand, it may rise by 20% on another day. You can think of the numerous coins on the crypto market like startups. Every single one of them has a concept that sounds very promising. However, you should not blindly rely on these concepts, but ask yourself, does something similar already exist? What would be the advantages of implementing it in this way? These are key questions that you can use to rule out many coins on the market. The performance will be very interesting. Do not start investing in the crypto market until you have sufficient experience. Many major investors will advise you against investing in this market. However, you should not let this unsettle you and concentrate purely on future developments. Many people remember the bursting of the dot-com bubble. However, very few people pay attention to what happened to the remaining companies. Companies that survived the dot-com bubble include Google and Amazon. If you look at the performance of these companies, you will notice one thing. Both companies are worth €1 trillion. Of course, the share price of these companies collapsed as a result of the dot-com bubble. Ultimately, however, the share price has risen tenfold, if not 100-fold, after just under a decade. If you have understood this aspect, then you have also understood that the value of the really important companies will still rise. That is why you should invest in this market with caution, even though high returns can be generated. The long-term favorites for wealth accumulation. What are the favorites for building wealth? Many people only invest in one investment. But is this really the right approach? Is there no ideal strategy that will allow you to build up a good fortune? First of all, it should be noted that you will never find the ideal strategy. The choice of a suitable strategy depends, among other things, on how willing you are to take risks. Only when you are clear about the level of risk you want to take can you put together your portfolio. For example, you need to be risk-averse to invest in cryptocurrencies, whereas this is not necessarily the case with real estate investments. In order to build up a fortune in the long term, you should take a few basic rules to heart. Many investors live by these rules, and it is not uncommon for them to be able to build up a fortune as a result. The first rule is that you should not put all your eggs in one basket. You can certainly do this. However, in this case, you should also be aware that you have entered into an investment with a high level of risk. you should also work on your mentality. In order to make money on the stock market, you need staying power. In addition to the right strategy, your mentality usually determines how successful you are on the stock market. Now that we have explained these basic principles, let's move on to the actual selection of the various investments. In times of low interest rates, shares are simply part of the portfolio. The stock markets can offer many long-term opportunities that you can take advantage of. Of course, you should also make a distinction in the stock market. This consists of which shares you add to your portfolio. Companies listed on the DAX offer the advantage that you are more secure than startups that have just entered the stock market. Of course, the return on startups is higher than that of large corporations if they perform well. Over time, you will be able to assess market trends better. It is therefore advisable, especially at the beginning, to invest in existing large corporations. This allows you to spread the risk, especially at the beginning, and subsequently has the advantage that you can also turn your attention to the dangerous markets in the stock market. However, if you are very risk-averse to begin with, you should fall back on ETFs. Of course, these do not offer the same high returns as highly speculative shares, for example. However, you will get a taste for the market and can gain initial experience. This can be decisive in the future if you decide to make your own investments without ETFs. You have to decide for yourself whether you want to play the market directly or choose a somewhat safer option with ETFs first. Which brings us to another rule. This is that you should set aside a certain amount of play money at the beginning. Make sure that the amount of play money does not lead to any financial restrictions for you. You can use this play money to explore the market. Despite all the tips in this book, you will make losses at the beginning. This is not a bad thing, as these losses will teach you something for further investments. By using your play money, you will expand your wealth of experience in the market and can make riskier investments later on. It is best to be aware of this right from the start. In addition to equities, which should make up around 30–40% of your portfolio, you should also invest in real estate. Contrary to the general assumption that real estate always rises, there are also phases in which real estate prices do not rise so sharply. However, with a property you have gained an investment that you can simply sell if the worst comes to the worst. On average, you can expect an annual return of just under 6% from real estate. Spread the capital in real estate according to your risk appetite. Another important aspect is that you should, of course, also choose investments that are speculative. After all, these investments are the ones where you can expect the greatest return. If you want to achieve large capital growth in the long term, you cannot avoid these investments. It is best to invest a small portion of your total capital in riskier investments right from the start. Cryptocurrencies are among the riskier investments. Here you can achieve a return of 20% overnight. However, you could just as easily lose 10% overnight. You should spread the profits you make from your investments. Always select a certain proportion of investment opportunities where you can achieve an almost certain return. But also make sure that you don't ignore the economic cycle. It is not worth having a large proportion of your capital in equities during a financial crisis. Which brings us to another tip. Approximately 5–10% of your portfolio should consist of precious metals. Why? Precious metals offer a very safe investment opportunity. The demand for gold will not fall in the future. In the global economy, trade always consists of a structure of supply and demand. The supply of gold is becoming increasingly scarce, as gold is a finite resource. However, demand does not stop falling. What happens to the price of a good or resource when supply becomes scarcer and demand increases or remains the same? Quite simply, the price will rise. This will also happen if a financial crisis breaks out. People will look for investments where they can store their money for the time of the crisis. After all, you don't want to lose all your capital. As you can see, with the right diversification, you can ensure that you have a certain degree of security in your investments. There are virtually no successful investors who have put all their eggs in one basket. As a rule, this does not end well. Of course, you can get lucky and achieve a high return this way too, but investing is all about the following keyword: diversification. This ensures that you can maximize your capital even in times of low interest rates. Why I see my favorites as winners. How do you choose the right shares? Is there a certain pattern you can follow? In this regard, it can be said that with a few tips, you can make the right choice and thus maximize your capital. The first important tip is not to be overly influenced by the media. Experienced investors know that you should not believe everything the media says. You can assess companies yourself and therefore do not have to rely on the news in the media. Analyze the media policy in detail. A particular event is always highlighted. A well-known example is the diesel scandal at VW. Of course, the share price collapsed, but this collapse did not mean that the share was completely wiped out. The clever investors kept buying small packages during this period of share collapse. After all, a car brand as big as VW will not go bankrupt overnight. On the contrary, after a strong phase of downturn, a share will also recover. Of course, the share does not always return to its original value, but if you bought at the low point, you have the decisive advantage of being able to benefit from the return. Another tip when choosing your favorites on the stock market is that you should say goodbye to your love of your home country. Don't just focus on shares from your home country, as these do not always generate the highest returns. In the technology sector in particular, one or two American companies may be ahead of the pack. Again, the key word here is diversification. This keyword also means that you should analyze international companies and plan investments in these companies. It can certainly be worthwhile. Another crucial point is that you should recognize false information. Not everything that is disseminated on the market is true. Time and again, investors experience the following event. They make investments, and by chance, the wrong information reaches them. The share price collapses. You think to yourself that you are now on the safe side. After a few hours, you look at the share price again and are surprised to see that it has recovered completely. You then look for more specific information and realize that you have been misinformed. Define your investment strategy from the outset. The stock market is not a gambling house, even if the media repeatedly portray it as such. The stock market is a market where the right strategy is crucial. How else did Warren Buffett manage to earn €1 million within a short space of time with an initial investment of just $100? The right strategy determines your success or failure. Do not blindly copy any strategies from experts. These strategies may also have gaps. Analyze each strategy to get an idea of the broad spectrum of different strategies. You can then go on to define your ideal strategy and use it. Always work with a proof of concept. What does that mean? The term simply means that you should test your strategy. Carry out a test run and analyze the effect of your strategy. If you were able to achieve positive returns, you should continue to use this strategy in the future. In addition to the stock market, you should also define a strategy for your other investments. Always bear in mind that you must take into account the inflation of the national currency in your annual return. For simplified calculations, assume that annual inflation is around 2%. You therefore need to generate a return of at least 2.1% in order to trade profitably. It is best to set yourself a desired annual return for a 5-year or even 10-year period at the beginning of the year. This can be 10% or even 20%. No matter what level you decide on, you should adjust your strategy to the level of this desired annual return. Of course, you should bear in mind that the higher the return, the more speculative investments you will have to make. This may well mean that you have to invest a larger proportion of your assets in cryptocurrencies or similar. Under no circumstances should you be afraid of this. Fear leads to many investors failing on the market more quickly than they initially expected. Avoid this trap and gradually build up your self-confidence through small investments. Increasing your self-confidence will make it much easier for you. Take this aspect into account when choosing your return and developing your strategy. The ideal course would be as follows. To begin with, set yourself small targets in terms of your annual desired return. You can start at 5% or 7%, for example. Within a year, you will gain a lot of experience in the market, and over time you will also learn how to analyze the balance sheets of different companies correctly. You can then increase your target return to 10% the following year, for example. You will be able to develop an ideal strategy based on the experience you have gained. If you are very unsure, it can be useful to have a mentor at your side. Of course, you should bear in mind that the higher the return, the more speculative investments you will have to make. This may well mean that you have to invest a larger proportion of your assets in cryptocurrencies or similar. Under no circumstances should you be afraid of this. Fear leads to many investors failing on the market more quickly than they initially expected. Avoid this trap and gradually build up your self-confidence through small investments. Increasing your self-confidence will make it much easier for you. Take this aspect into account when choosing your return and developing your strategy. The ideal course would be as follows. To begin with, set yourself small targets in terms of your annual desired return. You can start at 5% or 7%, for example. Within a year, you will gain a lot of experience in the market, and over time, you will also learn how to analyze the balance sheets of different companies correctly. You can then increase your target return to 10% the following year, for example. You will be able to develop an ideal strategy based on the experience you have gained. If you are very unsure, it can be useful to have a mentor at your side. If you've enjoyed the video so far, don't forget to like it. Subscribe to my channel and activate the bell to give the channel added value and support my channel for free. When is the perfect start? How do you find the perfect start for your investments? To begin with, it should be noted that the perfect time to invest can be different for each person. While you may find one particular time ideal to make your investments, another person may feel differently. It is therefore important not to get too fixated on the perfect starting point, as this doesn't really exist if you are thinking long-term. Investing is all about taking a long-term view. Short-term market movements are often unpredictable and can lead to impulsive decisions that are not always beneficial. A long-term approach helps you to smooth out market fluctuations and benefit from the general market trend. Historical data shows that stock markets tend to rise, although there are always corrections and dips along the way. One important aspect is that you gain experience early on. The sooner you start, the faster you will get to know the mechanisms and dynamics of the markets. In times of recession, for example, you can buy shares at more favorable conditions. These phases offer valuable learning opportunities, as you can follow developments on a market that is currently in crisis. Such experiences are invaluable and contribute to your long-term competence as an investor. While it is tempting to try to time the market and only invest in supposedly favorable phases, even experienced investors rarely do this consistently. Don't try to time the market. Instead, an approach such as cost averaging could be useful. This involves investing fixed amounts on a regular basis, regardless of the current market situation. In this way, you buy fewer shares in high phases and more in low phases, which reduces your overall costs in the long term. Another important point is to diversify your investments. Don't put all your eggs in one basket, but spread your risk across different asset classes and regions. This will minimize the risk of losses that can result from the poor performance of a single investment. Diversification is a key principle of successful investment strategies and helps to stabilize your returns. To summarize, there is no perfect starting point for investing. The important thing is to start and keep learning. Take the opportunities that come your way to gain experience and continuously improve your strategy. Take a long-term view, diversify your investments, and don't be unsettled by short-term market movements. Investing is a marathon, not a sprint, and patience and discipline will be rewarded in the long run. Dividends aristocrats. What are dividend aristocrats? When you read the term, you may have wondered what it has to do with investing in shares. Dividend aristocrats are shares in companies that have managed to increase their dividend payouts to investors over the years. Strictly speaking, these companies have generally managed to increase their dividends to investors every year over a period of 25 years. The dividend growth of these companies is usually 5 to sometimes over 15% per year, which speaks for itself. These advantages naturally enjoy various benefits as a result of this economic development. For example, they have the advantage of increasing investor confidence over time. Furthermore, these companies have a good reputation on the market. Beginners on the market in particular will fall back on these shares to play it safe. It can also make sense to include such shares in your portfolio in order to ensure an ideal retirement provision. However, there is also a disadvantage that you should not neglect. You only ever have past values to work with. No matter how good the economic development of these companies may have been in the last 25 years, you will never know what will happen in the future. What will happen to the company if the very sector in which it operates goes down the drain? Only very few investors think about these questions. They assume that the company will continue to develop positively. As a rule, however, the necessary data is lacking. Nevertheless, it should be said that dividend aristocrats offer a very safe investment. Particularly at the beginning, you can increase your self-confidence with these sometimes small jumps in returns before you make riskier investments. Finally, a few companies that can count themselves among these dividend aristocrats will be presented. One large company is 3M. It has been paying dividends to investors for around 61 years and has achieved annual dividend growth of over 10% in the last 10 years. Another company is Target Corp. You may have heard of this company before. It has been paying dividends every year for around 52 years. The annual increase over the last 10 years is just under 16%. Finally, Lowe's companies should be mentioned at this point. This company has also been paying regular dividends for over 50 years. The increase over the last 5 years has been around 21%. These figures speak for themselves, and usually also for the size of the respective companies. Finally, some advantages and disadvantages of dividend shares should be explained. How you weigh these up is of course up to you. However, one thing can be said: dividend shares are a sound investment. You are no longer speculating on the market, but your approach ensures that you can make sound investments. Furthermore, these shares are stress-free investment strategies. You no longer have to contend with daily price fluctuations and can simply sit back and relax. Another advantage is that you save a lot of time. You don't need a great deal of knowledge to invest in these shares. On the contrary, a basic knowledge of shares is all you need to make the investments. Another important aspect is that you can increase your self-confidence, making it easier for you to make riskier investments later on, which also bring a higher return. However, not everything speaks in favor of investing your money in dividend shares. One disadvantage, for example, is that you no longer have as much choice. You have to work with specific criteria and filter out the right shares. Another disadvantage is that investing in such a share can also be a short-term loss-making transaction. What is the reason for this? Quite simply, the state also wants a slice of the cake. This sounds obvious if you read the following example carefully. When a company pays out dividends, a shareholder pays tax in the form of withholding tax. This is rounded to just under 27%. If you now assume that you will receive the dividend minus your withholding tax, then in reality, you will only receive 73% of the dividend. However, the full 100% of the distributed dividend will impact the share price. As a result, the share price is depressed by a larger amount than the actual amount distributed. Dividend shares can therefore be a short-term loss-making business. Therefore, always do the math before you invest. Dividend stocks or price drivers or price maker. When choosing your shares, you always have the choice between dividend stocks and price drivers. Both have their advantages and disadvantages. You should make sure that you have both dividend stocks and price drivers in your portfolio. This allows you to spread the risk and also generate a good return. But what are price drivers anyway? First of all, it should be said that both price drivers and dividend stocks are shares. However, there is a key difference in how these shares are structured. As the name suggests, dividend stocks are securities that regularly pay dividends. You have already learned about these in detail in the previous chapter. The disadvantage of these securities is that the value of the actual company may be misrepresented. This chapter will therefore focus on price drivers. This term covers all the factors that cause a company's share price to rise. To understand how these factors work, you should acquire a basic understanding of the market. The price of a share is always the result of a balance between supply and demand. If the price should rise, the supply of shares of the respective company must decrease, or the demand for shares of the company must increase. But have you ever wondered why company shares rise in the first place? In the long term, there is one major indicator that causes share prices to rise. This indicator is the increase in a company's profits. The stronger and longer a company's profits rise, the longer the share price must rise. If the share price does not rise in a certain proportion to the rising profits, this can lead to the share becoming too cheap. This in turn makes it attractive to investors, which ultimately leads to the share price rising again. Over the years, several experts have addressed this issue. One of these is Castellani. Based on his research, he came to the conclusion that the relationship between the market economy and the stock market is comparable to the relationship between a man and his dog. If, for example, a company's turnover continues to rise, this could be interpreted as the master running forward. However, the dog, or rather the share price, has no desire to keep following its master. There are countless stimuli that affect the share. Sometimes the territory has to be marked, even though the master continues to lead the way. At some point, the dog makes a huge leap forward. This causes him to catch up with his master. This can be interpreted as a jump in the price of a particular share. The whole process is illustrated once again using the example of Henkel. Henkel is a DAX-listed company. This means that Henkel is also one of the 30 largest German companies. Since 2003, the company has increased its earnings per share from under €2 to over €5. This equates to an increase of over 150%. However, from 2003 to 2018, the share price has remained relatively constant in relation to the increase in earnings per share and has developed upwards. However, if you only look at the period from 2015 onwards, you will see that the company's earnings growth has come to a standstill. The profit of the company itself increased, but the share performance followed later. In addition to these long-term indicators that lead to the markets being in equilibrium, there are also short-term price drivers. Short and medium-term factors can quickly lead to a company making a 5% loss or profit overnight. One reason for this is that investors always have expectations about the future performance of a particular company. If you look at the market before the announcement of any quarterly figures, you will see that investors compare the results with expectations. If these differ greatly, this will cause the share price to fall. However, the opposite scenario is also possible. If a consensus view emerges, this can cause demand for the share to rise. When demand rises, the share price usually rises too. If you are focusing on short-term investing, you should ask yourself whether the stock market is really the right investment. As a rule, you can only speculate in the short term. You rarely have a direct insight into the various companies. This means that you are unable to view the various key figures properly. A current example at this point is IBM. Following the acquisition of Red Hat, the company's shares suffered short-term losses. This is understandable as 1/3 of the turnover was invested in the acquisition of the company. However, the future always remains open in the technology sector. Short-term indicators cannot give you an idea of how a company's profits and sales will grow in the future. IBM has managed to reposition itself time and again over the decades. This has generally been successful. For example, they have successfully implemented the transition from IBM notebooks to the current cloud structures for large corporations. You should always wait and see how a company develops in the long term. To do this, it is worth analyzing the balance sheets of the last 5 to 10 years. In an interview, Warren Buffett was once asked how he finds the right companies. His answer was, "I analyze all the existing balance sheets of a company and read through all the media reports. This enables me to identify a trend and make my investments on the basis of this trend." This was the 8th part of the series. How does money and our global economic cycle work? I hope you enjoyed the video, so I would be very happy if you give me a like, subscribe to the channel, and activate the bell. That way you won't miss any more videos from me and you'll be informed immediately when a new video is published. Thank you for watching the whole video and see you soon.